Good afternoon, traders, and welcome to the Wave Theory class. Good. Two things before we go. First, you're here for a lifetime. If you're serious about being a trader, you're here for a lifetime. Don't worry. Don't worry about anything, right? Don't worry that you're not going to make it in time. You're going to miss a class. You wouldn't get your questions answered. You're confused about something. Don't worry. We're here. You are here. We're going to help you, right? So don't get too nervous or too worried. Everything will go. We will have, by the end of the course, you will see that all the things that are bothering you and you're worried about and you're nervous about is just a waste of your time and your energy, because all your questions will be answered. Every single thing. There's a reason we keep you here for life. If we weren't planning on making you a good trader, we will give you 6 weeks and say goodbye, like most people do. And I'm not selling you anything because you already bought the course. I'm just telling you this as a fact, right? I'm not trying to sell you the course here. I'm just trying to tell you how it will work so you don't have to worry very much, right? You would get all your answers to all your questions. You will get enough practice, more practice than you would ever want. You will get everything. You will get all the recordings. If one of the recordings that don't work, don't worry. We will do those classes even during the time when we don't have courses. We will redo some of those classes because some of you will still have questions. And we will do special classes in between. We do a number of those special classes. As I get the feedback from traders, what are their weak points? We will do that, right? As you start to trade, you're going to get more confused. Don't worry, you will get more confused when you start to actually trade what you've learned. Because what you have learned and when you start implementing it, you're going to find that it's not that easy. You will be a little confused because you'll be thinking, oh, well, is this a 15-minute flag? Is this a 1 hour, structure and all of that? And it will take time to fall in place, but we are here to help you make that happen. There's a reason I do the daily update to show you what I see, because you may be doing your preparations and when you come, you see something different from me. What you need to do is go back, look at what I show you, go back, look at it the way I see, look at the way you see, and maybe you are correct. Don't worry. Sometimes, the traders come up and said, I have something else in a 4 hour, and I look at it and I said, oh yeah, great. I wasn't looking at a 4 hour at that moment. So don't think you're going to be wrong. You could be correct. So you need to just go back, look at it, look at what I did, and ping me a message and said, is this possible in the 4 hour? Don't try to do all that right now. I see traders are trying to prepare charts right now, and you are not even in the first week of trading. So don't worry. Take your time. I want you to load. Take your time. Remember, go step by step. The more it looks easy to you, the more you should tell yourself you're missing something. The more you look at the webinars and say, well, this is pretty easy. I could draw those lines. Tell yourself, wait a second, something I'm missing. Let me go through back this. Let me take another chart. Take a chart that you think is much more difficult and try it again. You know what we're going to be? If you think it's too easy, you're doing it in the Euro, the Aussie, the New Zealand, pick one of the Swiss pairs and try it again. And when you get a little confused, go back, watch the webinars, rewrite the rules, look back at the chart again and said, what would the rule tell me to do here? You see? Then you would know that it is not that easy as it looks. If it looks too easy to you, you're missing something. Let me say that again. Go through and do it again. We are giving you enough time to take your time and learn this stuff, because we know we have been through this before. I've had students who had the same thing when they were like, oh, that's pretty easy. I'm going to walk through that. And they start presenting and the first question and they're blank. They can't go further. So it's going to happen. Maybe a few of you will get that. Don't worry. Those students are probably the best students right now. They're the best traders right now. Because then they realize, hey, I have to go back and learn this stuff. So they turn out to be very good. Let's go. Today's topic we're going to do is MACD, another tool that we use. There are very few tools we use. MACD. Two things we use the MACD for. I think all of you know what the MACD is, right? The MACD is just a number of the moving averages. That's the name, right? Moving average, right? Right? Moving average. That's what it's built with, right? Anybody know what the C start for? Not my old students, because you know what it is. Anybody from the new students know what the C starts for in the MACD? Convergence, divergence. Exactly. So nobody uses convergence when you trade, right? You don't hear people say, hey, we have convergence in the chart. So nobody knows what that is really, right? They don't show you what that is. They show you always divergence. And all of you did physics, so you know what convergence is, right? If you're in an uptrend, What the MACD is telling you, what the MACD is actually telling you in simple terms, is when the momentum is moving away, the opposite direction of what the price action is doing, right? That is what it's telling you. Simple. It's just telling you that price action is doing one thing, but the momentum in the chart is doing another thing, right? Volume, momentum in terms of volume that is coming in that can be calculated based on what you have on the chart is doing another thing. The good thing about it is that it's very, very, very accurate. It always, if you have divergence, it's always a warning sign that that momentum is dying. You could get either a pullback or a reversal. Which one you would get would depends on where you are on the bigger structure. So today we'll go into divergence, and if I have time, I will show you how we use the MACD also. So we use the MACD for two things. One is to see divergence in the chart, and the second one is to identify what is a single wave. Why most of you are here, right? So if we have time today, I'll try to fix it and do it today so that tomorrow all your questions will come on, because we'll have to repeat it tomorrow. So divergence, all of you know what divergence is. Divergence is telling you price action is going up, right? If price action is going up, the MACD is actually going down. If price action is going down, the MACD is actually going up. You can see, right? This one is convergence. The yellow one is showing you divergence. They're diverging. This one is converging. That's what it is. Simple, right? Convergence, divergence. That's what it's showing you. How you see that? Let's go pick a chart. Let's go for the daily. Oh, I need the Pong, right? The Pong was the one I was doing it on. So let's pick the Pong. Let's go to the daily chart and let's find a place that we have the divergence so you can see. Let me find a bigger one so you can, yep, you can see it here actually. So let's look at this piece. First, I need to tell you how you should look at divergence. So let me bring that down. Divergence, you would look at only between impulses. The rule number one, in an uptrend, you're looking at divergence between the top of two impulses. For simplicity's sake, we are also going to use just divergence. We wouldn't use convergence. I'll show you what it is, but we will use divergence just to simplify it, right? Since all of us talk about divergence. You're going to look for divergence between these two, which means the MACD has to diverge between those two, right? So the first MACD will go up like this, come down back. It will come to the zero line. It will go back up. Show you there. You will see this one will be higher. That means we have divergence. The MACD is lower, but the price action is higher. So in an uptrend, you would look at two impulses. It is always between two impulses only. On a downtrend, you're going to look at the same thing. Divergence between two impulses going down. So you would look at the below the zero line. You're going to have one like this. You're going to come back to the zero line and you're going to have one like this. This is going up and the price action is coming down. This would be your convergence. See that? If you pull these two together, they will converge at some point. So in a downtrend, it's convergence. In an uptrend, it's divergence. But for simplicity's sake, we will say we have divergence here too. Right? We're not going to confuse the rest of the world. Right? Because if we go and say, hey, there's convergence in the chart, a lot of people, 80% of the world out there will say, what the hell is he talking about, right? Right? Yes, we will come to that part, the zero line part. You just remember the divergence and the convergence part, right? We have something called internal divergence. I'll come to that, right? So I'll show you how we do it, how we're going to measure that. So let's go to the weekly so we can have some clarity in here. Go to the monthly, make it easy. For you to look for divergence on a chart, you first have to have an impulse, a correction, and an impulse. How does the MACD work? When you have an impulse, the MACD is going to show you one peak like this. Then it must cross over. When you get the correction, the MACD will always cross over. Right? And then you're going to get another impulse. You know what an impulse is. It has to break the low. So you wouldn't be looking for MACD if it doesn't break the low. And you would look at this. That's called, this is the convergence. We will call it divergence. You see how they will converge if you pull them together? That's the convergence part. Right? It's the same thing. We just call it, we'll call it divergence. Just for simplicity's sake, they're diverging, right? But that's the convergence part. This will be your convergence point here, right? So you will see that price action is lower, but the MACD is not going lower. That is how you're going to look at divergence. You must have the crossover. So what if we get a piece where there is no crossover? Say, for example, this one. You have a move, you have a correction, you have another move. There is no crossover, but you can actually see the divergence here. We call that internal divergence. Remember that. This is the only place you're going to hear that terminology. It's called internal divergence. It's divergence within a single move. This is, remember, this would be a single piece on the chart. That will be one piece of its own on the chart. You get divergence inside of that move on this time frame. If you go one lower time frame, this internal divergence becomes divergence. That will be, you will see divergence there on a lower time frame. But in this time frame, it is one piece. And a lower time frame, it's going to be more than one piece. In this single piece, we see divergence. So you're going to hear very often the guy says, we're getting internal divergence in this thing where we should look for a sell. Or somebody's going to say, I'm looking at the euro, there's internal divergence on the daily euro and the 240. What they're saying is that the 240 move, the single 240 move, is creating internal divergence. That means two things. We're about to make a correction, or we're about to turn, depends on where you are on the biggest structure. If it is the end of a big structure, we're going to reverse. If it is a continuation, which means your structure is not ending, but you're expecting a correction to continue to go down, right? So that is what MACD is showing. When you see that, it's not telling you which one is going to happen. The structure will tell you which one is going to happen. But it is telling you that the volume is dying out, and you got to be careful. It will go into consolidation. And if you're at the end of a structure, it's going to reverse. Normally, where we will look for reversal? We will look for reversal when we have daily, weekly, daily, monthly, 240, 60-minute divergence, and the structure is about to end, we're going to look for reversal. When you have divergence in all time frame. When you don't have divergence in all time frame, what it means, if you have it in the lower time frame but not in the higher time frame, is you're going to have a lower time frame move in the opposite direction, but it will continue to go on the bigger time frame. So let's say you have divergence. Let's just say, for the sake of argument, we had divergence in here, but we didn't have divergence here. It means this will pull back and go again. So if you get divergence in a 60-minute chart, you're looking at a 60-minute chart and you look and you get a move up, you get a pullback, you get a move up, and you start to see divergence here at the top there on the 60, but you don't have divergence on the 240. The 60-minute is considered a dominant one. It means this will start to pull back. And if you don't have divergence between this and between this whole move, you're likely going to have one more up. See? So I can find a chart that has that. I think we can go in this very chart, and we'll go into this piece here, probably daily, so we can explain that part to you. So see this piece here? We were seeing divergence here. We thought that's the reversal point. See that? But as soon as we realize that this is still this move with correction inside, this might not be the perfect one because this is more of an running flat. You still have one more move up. And the reason we look for that one more move up is because in this one here, right? We thought that this is making 1, 2, 3, 4, 5. We realize it's not 1, 2, 3, 4, 5 very late. Well, not very late. We realize once it started to go, it's not that. This is an entire move of its own. We'll come to that why this is. So we don't have between this and between this here, we don't have divergence. This is all one piece. We'll come to that later. Just take it for now that it's one piece. We don't have divergence between these two, which means if this makes a deep correction, we're anticipating one more move up. We're always anticipating one more move up if we don't have divergence on the time frame we're looking at. Not necessary that it would happen, but most times it does. Do the actual lines have to cross, or it is just the direction of the lines? Which actual lines have to cross? Not sure what the question is. Right? Which actual line? You have to get me which line. Okay, so if you're confused, James, I'll go over back it again. Let's go. Let's start from the very beginning. We'll take our time. Don't worry. All of you will get it. First, what is divergence? Is that clear to everybody, right? If it's not, don't answer. Just if it's not clear, then you're going to answer. Divergence, we check only impulses in the direction of the trend. Two impulses in the direction of the trend. And an uptrend, in the downtrend, it's going to be the same thing. You check between the last two impulses here for divergence. Any two impulses, any two. It could be the last two, it could be the first two, but you will not see it. You'll normally check on the last two to see when you're going to get it, right? Is that clear? That's where we will look for divergence, right? Everybody knows what divergence is, right? You're looking for the MACD to show you that, right? So let's say these were the last to move down. You could have seen that if this was the MACD, we have divergence. Make sense? The price is going, but the MACD is not going. On the upside, if these were the last two, you can see we don't have divergence. So what we are going to expect when you don't have divergence, you're going to expect it to come back here, go back one more, and give you divergence. You will see us do something like that. Go back here, give you divergence, and then start to go down. For example, drawing line and MACD and upline and chart. That's a trend. You're measuring within the same trend. Divergence has to be within the same time frame, the same trend. Oh, you mean the lines I'm drawing? No, that is just showing you what is convergence and what is divergence. The lines has nothing to do with it. The lines is just showing you that they're. Okay, I see where you're getting the confusion because I pull the lines to show what's convergence and divergence. The line has nothing to do with it. You can use this line. See that? You can pull this line here. And I can tell you that right now in this pair, in this trade, that this one, the price is lower than this, but we have divergence. See? You had a move like that, you had a pull back, you had a move like that, you get divergence there, and then they go back up. See? We are checking these two. This one has to be lower, the first one lower than that one, but the price action is lower than this. The lines, you don't have to draw them. I'm just showing you what is convergence. You don't draw the lines. You can just put this line. And as long as this is above, but the price action is below. By the way, when I do webinars, you'll notice a lot of these lines on my MACD and my charts, right? A lot of them putting at the tops. We're actually looking for divergence. We're waiting for them to break the top, make divergence, and go the opposite direction. A lot of people ask about those lines. They never got the answer what they are for, right? So you see, that is what you're looking for. So if we pull the price action up here, see what I'm saying? You make an impulse, you make a correction, you make another impulse. See the divergence there? Price goes correction. The same would be on an uptrend. So let's go pull an uptrend here let me go backwards and find an uptrend where there's divergence. That would probably help. Look here, for example. This one is not going to give you clearly. Let's take this one. This one is a better one. Any one of these trends that has divergence. Take this, for example. Up move, pull back, break the top, divergence. Clear? This divergence signals a reversal. Okay, is the divergence part not clear to anybody? If it's not clear, don't be shy. Give me a Y, which means it's not clear to you. Okay, so we still have some Ys. Let me get the questions. Let me just read through the question. We are always using the last two impulse. Yes, that's the rule. We gotta wait 1 second. Let me just make sure I get a question. Can you give another example, please? I'll give you more examples. If the price chart is an uptrend, but MACD is with the same height, do you consider the yes divergence? If the MACD is the same height, divergence. How do we get the same MACD setting that you have? That's a different question. You'll get it. It's a standard setting. I think you'll get that from the rule. We need more examples. Okay, I'm going to give more examples. I'm trying to see where you guys are not getting to it. In late, my work is clashing with the classes. That how that got to do with the MACD? We'll come to that part in a separate one. Divergence is uptrend. MACD second impulse lower price. Next we have reversal. No, not always reversal. It could just be go into correction. Just here's, I want you guys to figure out what is divergence first. Everybody clear about what is divergence? Not any other questions about whether it's clashing with your work or so. Do you understand what is divergence? If not, give me a why. If not, give me a why. So 2 people don't know what divergence is yet, or 3. Okay, good. So let me go back with what is divergence. That's what we have to get through what the divergence is first. Divergence is when the price action is moving away from what the momentum in the market is doing. We use the MACD to measure the momentum. So it means when the MACD is not doing exactly what the price action is doing, we have divergence in the market, right? So let me show you what that means. I'm going to draw so you can see. We are in an uptrend and we have 2 impulses. We have an impulse up, we have an impulse here. For you to have a trend, you must have 2 impulses. You put the MACD and the MACD will show you, the MACD will follow the impulse like that. Let me use a different color. The MACD will follow the impulse like that. The MACD will come back down, cross the 0 line, and go back up like this. Come back here. If they are flat, sorry, that line is not straight. Let me see if I can erase that one yet. Put this one higher so you can see it. If this price, if this MACD point is higher than this MACD peak, right? And the price action here is higher than there, we have divergence. And I'm showing you what divergence is. I think this is easy. What they're showing you is that they're diverging away from each other. Right? All of you did physics in school, right? You wear lenses, you wear glasses, you know what that is, convergence and divergence, right? Everybody knows what that is? Easy, right? You remember when you do physics in school, they show you these 2 lenses, concaves and what is the other one? Rays goes into here and then they diverge, right? Convex, right? Then the ray goes into here and they converge, right? That's what they're talking. This is physics, simple physics. It's not difficult. One lens will converge, one lens will diverge, depends on whether you're long-sighted or short-sighted. So what they're telling you here is they're using the same words. Remember, all these things are based on knowledge. They're not based on just anything. What they're telling you is that the MACD, when you have a trend going up, and the MACD is not going up, which means the MACD following the trend will always follow the MACD should always follow the price action. And when the MACD comes back here and it's not following the price action, it's much lower. When the MACD is much lower, but price action is higher. See, price action is good. We have divergence, right? If you pull the lines, they're diverging away from each other. They're not coming together. They should be parallel, right? This one should be like this. If on a normal one that you don't have divergence, I'll use another color. This is what it would look like if you don't have divergence. And the 2 lines will go like this. They'll pretty much be parallel to each other. So you can draw this green one a little higher, right? These lines will be parallel to each other. Very close to parallel, put it that way. They wouldn't diverge away from each other. That means they're telling you you're going to get more up move. There is more momentum coming, more volume coming in the buying, and this will continue to go up, right? That's what they're telling you. But when you have the other one, which is it's not going up, the price action is going up, but the MACD is not following. See, the MACD fails to go up. Then we say you have divergence in the chart. Be careful. Price action is going up, but there's no momentum to support it, which means this will lead to 2 things. It will lead to either a retracement and then continue to go, or a total reversal. That will depend on where you are on the structure of the chart. right? So don't worry what it will lead to. Just worry what the divergence is, so that you understand what divergence is, right? Right? Is that clear to everybody now? Good. Let me take a pause here. Anybody now still don't understand what is divergence? What we look for is divergence in the chart. Don't be shy. I can do this. I will do it 100 times if needs be. My job is to get it over to you clearly. Right? What will happen when if the MACD is the same, still divergence. If the MACD is slightly above, no divergence. It has to be the same or below. Consider divergence. Guys, slow down. Don't worry if we have three impulses. The question is simple. Everybody clear about the divergence. What is divergence? Not where and everything. Just what is divergence? Is that if we don't get that clear, we can't move on. Good. So let's take a pause. If you're not clear that about the divergences, don't be shy. Give me an N on the chart, so I will know you're not clear. I don't want to leave anybody behind, because as I move on, it will be complicated. So we still have one person not clear about it. So let me go over back again. No problem. We'll do it until everybody gets it. When you're trending in an uptrend, you're going to get an impulse, a correction, and another impulse. We use the MACD to tell us, is the momentum in the chart dying? Right? Is there momentum pushing the price? Or is it the price just going because very little momentum and somebody is buying? So the volume is there, but the volume is much less than it was before. Right? We look at the MACD for that. If we see the MACD showing us up move, pull back, come back to the zero line, go back up with the peak, but this peak is lower than this peak, which means the peaks that matches this impulse and the peak that matches this impulse is showing us that this is lower. We say we have divergence. Is that clear? It is for the one person that didn't. Great, so good. We can move on from there now, right? The same thing we do on the downtrend. When you have a downtrend coming, we will put the MACD on, and you will see the MACD peaks will go like this, follow this up, come back here, and follow this. If it is like this, that's normal. When we look for divergence, I'll use the other one. When you look for divergence, you'll see something like this, follow that, and it's going to be like this. This means we have divergence. This peak is higher than that peak. The price is going down, but the MACD is going up. That would be divergence on a downtrend. Everybody got that now, right? So we're over with what is divergence. We already know now what is divergence. Let's move on to the next stage. How do we use divergence? And what do we use divergence for? So, great, let's go. Don't worry, we will make sure everybody get it. If we have to do it over and over, we will until everybody get it, right? We're not going to leave. You don't have to be worried that you're the only person. We will make sure that you understand. Let's go. How do we use divergence and what do we use divergence for? We use divergence to tell us when a trending move or a corrective move, a corrective structure is about to end, right? If a structure is about to end, you're going to see that momentum starts to die in the chart. So let me take one that is going to be very, very good for you to understand. S&P 500. I'll take this for a specific reason because this is at the top. What happens when you get a trend going up like this, right? They make an impulse, they pull back, and they make another impulse. See that? What happens here? We get divergence. So when I see something like that, I'm immediately thinking, you know what, guys? Expect a pullback. There is no momentum. There is no volume trades coming in to push this anymore. They're going to pull back. So you start looking at the structure for sell signs. And you definitely got your sell signs. They pull back. Now, if this was the end of a very, very big structure, I would say, oh, watch it. This is going to be a big reversal. But we didn't see a big reversal come because we know structurally this thing has more to go. You get another move up, you get a pullback, and you're getting this. We see divergence. What do we say? Be careful, guys. A down move is coming, right? You got divergence. You start to get this pullback. I said, watch it. This could start to be a bigger correction. It started to come down. It started to come down, but then we see that the downside is actually just making a little consolidation. See, just a little consolidation. It continues to go up. You still have divergence. We get another pullback. We said, watch it. This could come. It didn't come. It made another consolidation. We saw that that was a consolidation, and we said, okay, we still have divergence here. We said, watch it. It's one more up. We still have divergence. If you look at between the last two, these two here, we still have divergence. I'm saying to you again, watch for this move. Right? This move is still coming. This is extending. The price action is still going. The price action is still going. But guess what? We're still getting divergence. And that means that at some point, this thing is going to make a sudden fall. You're aware that it's going to happen. You got to be prepared for it. Now, is it going to be just a correction like this and they'll continue to go? Or is it going to be a fall through the trend? At this point, you wouldn't know that. And at this point, it's not important for you to know that. It's important for you to understand what we use divergence for and how we use it. So let's see how we're going to look at divergence on the different time frame now. Right? To see divergence in different time frame, we'll start with the monthly. And I'll go with this chart because I think this one is still important. Take this out. Come on. You have one big move up. You have a correction in here. And you're getting another impulse up. If you look across here, you can see we don't have divergence. No divergence. What does that mean to us as traders? Remember, I just showed you divergence at the top there, and I said, watch it, we could get a big move to the downside. What that means to me, come on, this chart is not, it's not responding. What the hell is wrong with that? Why can't I squeeze it? What the hell? It's not squeezing something. The side one is not. Did I fix it? Auto scale. Refresh it. That might help. Let me see. It's normally able to squeeze it. I don't know what the hell wrong with it. So. Okay, got it. Let's go. So, go back to the monthly. And great. What does that mean to me when we don't have divergence? Let's put back that line there. No divergence. That means that if I don't have divergence between this and between this, I'm expecting a correction like this and one more impulse up. So if I have to make a forecast on this chart right now, and everybody, this thing starts to fall, and everybody said, "Oh my God, this is the worst bear market you're ever gonna get," I'm like, no, it will probably do this, and it's gonna go back up. We will see divergence here, and then we're gonna get the worst bear market you ever see, right? Then you're going to get the worst bear market. Not now. Now you're only probably going to get a correction and one more impulse higher. Right? Everybody understand this, right? The reason we are always looking, when we don't have divergence, we're always expecting the trend to continue to go up after a correction. So when would that correction come? That correction will come when you start to see divergence inside of this here, inside of that. And that is what we call internal divergence within that move. You can see that inside here, we have divergence. See that? Inside this move, there is divergence. So what it is telling me that this move here is showing me divergence. And this means we could start to get that. We could get this. We could get that. And then we could go back for one more up. Anybody want to tell me when we can forecast that up? When we see divergence between these two, between this and between this, we will see divergence at the bottom there. When it will get to the 270, maybe it wouldn't. Like in this case, you see they never got to the 270. Right? I think this was an expanding flat, by the way. So you're going to look at that. We would look for divergence here to give us a sign when this up move is going to start. We're also going to look for divergence inside of this move here, coming down. That single move coming down. Inside of that will also be divergence. So what are we looking for to tell us when this move is ending? Let's go to the weekly. And I think you can clearly see what we have here now. Right? We're going to come in a weekly and we're going to say, is this move here over? Is that move over? And if you pull a trend line here, nope, not over. See? We don't have divergence between everything in that move. Nowhere do we have divergence in that move. So what does that say to us? This move here is not over, right? This here is not over. They give you a pullback. They will go one more up and then give you divergence. So we need a crossover here. We need a crossover like that. We need a crossover like this. So we want this to come back here, give us a crossover, go back there, give us divergence, and then that move is over. See? So within this move, if you get a small one here, pull back like this. That is this one. That is this one. We might get one more like that. Very likely. Not this one. This one would be smaller. This would be one like this. Sorry. We'll get, that's the big one. Sorry. One like this. We'll get one more like this. Here. And then we look for divergence at the top there. Then you get these bigger pullback. As long as we don't have divergence in the chart, we're always looking for one more move up until we see divergence. What they're telling us is that there's a lot of momentum coming here in the buying. And if you get a pullback, that momentum is not dead. It's going to come back in the chart. Once you get a pullback, the buying will come. And when we see the buying dying out, the market is going to show you momentum in the chart. That means there are no willing buyers. Nobody's coming to put money in there anymore. Wait for deeper pullback before they start buying again. See? That's what we use MACD for, to tell us when a move is over, either for a reversal or when a move is over for a correction. Okay, wait a second. Can everybody hold? There's a question here. We don't have divergence in the last correction, but we still went up. We don't have divergence in the last correction. I think that's exactly what I'm saying. Divergence, you mean there was no divergence for the pullback? You check, there will be internal divergence. Every time you get a pullback, there is internal divergence within the move before they come back. So if you look at it, you will always see that there is internally in that move, there was divergence. You will probably not see it in this time frame. You see it in a lower time frame. You're going to get divergence. Not every time you get a pullback, you will get divergence, but most of the time, we would look for that. The divergence is a very, very good tool in telling you when the momentum is dying. Sometimes they do pull back without divergence. We can expect that maybe this move will come back very sharp without the internal divergence. I've never counted the percentage. There's no need to worry about the percentage. It's simple. Every time you see divergence, expect a correction. If we don't get divergence, we expect one more move up. On the dominant side of it, the structure will still tell you when that is coming. You wouldn't look for the downside until the structure tell you you're getting a downside. But the MACD is warning you way ahead before that happens. The MACD will give you a clue way before it happens that it is about to happen. Now, divergence never means the end of the move to the upside. Right? You can get divergence and that thing could go on for a very, very, very long time, but you will get continuous divergence. And if you keep getting continuous divergence, that will be a great warning sign that any time you see a setup for a sell, you need to be in it. If it's the opposite, anytime you see a setup for a buy, you need to be in it because it could be a big move. Make sense to everybody? Great. So 1 second, let's hold the questions. If you guys keep the questions to the end, I'll get them, because after I finish every piece of it, I'll take the question. Let me see your questions. We had some questions. Let me go through them, because I can't read the chat and look at the chart at the same time. There are two different screens I'm looking at. So let me see what were the questions. A lot of questions. Is that means the first big pullback didn't have divergence? Oh, between those two, you wouldn't see divergence. We'll come to that. We'll come to that, because that's an expanding flat. We don't look for divergence there. I'll come to that just now. Very good question, by the way. Second, is that mean that the divergence happened? Does that mean divergence of the wave is going to end one piece and expect the break? Yes. Every time we see divergence, we're expecting that move to end, right? Sometimes it keeps going, but you keep getting divergence, especially when you're making an ending diagonal or you're making a channel at the top. Right now, they're making a channel at the top. And that channel will break to the downside. Don't worry with the amount of move. Always a 5 move up. Don't worry with that. Can you guys type your question to panelist and attendee? Otherwise, I'll have to read the questions, right? Somebody said always a 5 move up. It doesn't matter. It could be three moves. We're not looking at the amount of moves that is going to be here. When we're looking for an uptrend, we only look at the green. Forget about the color. You're looking at the peak of the MACD on the upside and the peak of the MACD on the downside. It doesn't matter what color you color it. In this case, the green, yes, but some people will have white MACD. The percentage, we don't calculate the percentage. It's not important. You don't need the percentage. You just need to look for whether there is divergence or there isn't divergence. The pullback before we going back up, there was, I saw that one. I'll come to that. Do some of the patterns not use divergence so we can rule them out? We will come to that when we do pattern, Carl. Those are the expanding and the running flats and the contracting flats. We don't use divergence there. We'll come to that. Let me go to this class is to help you understand two things. Let's go step by step. I think the problem is most of you look at all the webinars already and you're trying to go ahead of yourself. Let's look at this. Don't worry with the patterns as yet. Try to make sure you understand what divergence is and how we use it. When we come to the patterns, we'll tell you which one of them we use it on and which one we will not use it on, right? So we'll go there. Don't go too ahead, because not everybody saw all the webinars. But if the second impulse has divergence from the first, but the third impulse doesn't have divergence from the second, divergence still valid? Yeah, no. If the second impulse and the first one has divergence, very likely, if you're getting more upside, it is going to be a bigger wave. So the first and the second impulse would be one piece of its own. It's likely going to break the structure, then go back up. There is only one case where you can have that, where it's not going to break the structure and go back, and that's ending diagonal, and very often you get divergence in the final one. So we'll come to that part when we do pattern as well. I'll probably show you that now too also. Can you show us divergence inside a flag on the chart, for example? We'll come to that. It's the same thing as when you're doing pattern. Which pattern you're looking for, if it's an ABC or not. In the future, in the trading, should we say convergence? No, you can just use divergence. We just simplify divergence. Everybody use divergence. Okay, let's see. So the degree of divergence doesn't influence the degree of the correction. That is it. No, degree of divergence has nothing to do with the degree of the. We're just allowing the pattern to play out, and then we see whether it has divergence in it. Can we know that the pattern on the chart drawing from? Can we know that pattern, the chart drawing from divergence? Not sure what you mean by that, Bassem. Can we know what pattern probably with the chart drawing from divergence? Can you restructure that for me, please? I'm not sure what you're asking. Just restructure it for me. Yeah, it could be my side. I'm not getting it there. Any difference between the standard magnet? It's the same thing. It's just the color. No difference. No, patterns would be in the third week. If there's a crossover, does it mean that part of the wave is corrective structure? Crossover, where and what part of the wave is corrective structure? Don't worry about the structure, where the impulse is. But look, understanding the divergence. I'm not sure where you're looking for crossover for corrective structure. Do you use the dark and the red shade and the MACD to validate anything? No, just forget about the color of the MACD. Standard setting. Let's get back on topic, guys. I think he means you can identify a pattern by looking at the MACD divergence. No, you can't identify the pattern by looking at the MACD divergence. No, the MACD divergence is not to tell you what pattern you're looking at. Okay, let's take a pause now. No more questions. Stop there. Let me go through back this again, because I think you guys are putting a little more into it than there is to it. Divergence is only telling us two things. Not what structure we're looking at, not the color of the MACD, not whether there are only two things it's telling you. One is that momentum in whatever the move is dying out. Whether it's an up move or down move, it doesn't matter. We're telling you that the momentum that is pushing that move is no longer there. That's the one thing it's telling us. And the second thing it's telling us, the second information it's giving us, is that if that happens, you're likely going to have a turn, either for a correction or for a reversal. Which of those two will happen will depend on where you are on the bigger structure. We will come to which one will happen when we are looking at structure. That is on the third week, right? I want this week for you to grab what is divergence and how we use it. So you know what is divergence already. You know how we use it and understand what it's telling you. Those are the only two things, nothing else. The MACD is standard. The color of the MACD has nothing to do with it. We are only dealing with the peaks of the MACD. Just the peaks. Right? Nothing else, just the peaks of the MACD and the impulses, which is, this is one impulse and this is another impulse. For us to, if you want to get rid of all of these breakout, and you should get rid of them, go to the monthly and you're going to only see this. You're going to see one impulse up here and you're going to see another impulse up there. You're going to check between this whole piece here, the highest peak in this one and the highest peak in this one. Make sense? So if you're looking for MACD in the monthly, if you're looking for divergence in the monthly, you're looking for divergence between this impulse here and between this impulse here. If there is no divergence there, then you go within this one and you look for divergence within this move. You can go on the weekly and look for divergence within this move. What you're going to look for within this move is you have a move up, you have a correction, you have a move up, you have a correction, you're getting a move up. And you look to see if you have divergence within this. And it's telling us, no, there isn't any divergence there. Right? Now, we would come to what is the possible move this could make. What this is telling me, I look for two things. Do we have any expansion happening, like an expanding ending diagonal? No, we don't. So it's telling me there's a likelihood that we could either watch for internal divergence in here, which means this come here, go back and give us divergence, then come down. Or this move could come down without divergence, give you a deeper correction, and then go back up. That is if this one is completed. If it's not, I'm always going to look for one more correction, one more up move, and then look for the big correction. See? Always going to look for it, as long as you don't have divergence. We will come to what the pattern is and what it's doing. What is likely? Let's make an assumption. I don't want to confuse you guys, but let's make an assumption this is over. Then you may get a deep correction, but not a deep one like this. You may get a deeper correction here. You may get another wave up, give you divergence there, and then get that bigger correction there. Right? But that will come when we do structure. I just want you to understand now what we are expecting when we see the divergence. So if what you're going to do now is you're going to look within this last impulse. That is this last impulse. If you want to know when this is about to turn, to come down, you're going to look within that last impulse and you'll go probably in a daily. And within this last impulse here, you can clearly see that we have divergence. But it's continuing to go up. And this could continue to go up and continue to go up and continue to go up. And you would continue getting divergence here, sorry. Eventually, this will fall. So from the time you see divergence, you start being careful. You don't stop trading, you start being careful. You're looking at the structure it's making every time. And every piece of that structure will determine, is there one piece more up or not? So when we saw this, and we saw the first turn here, when you saw the first turn there, we think, okay, this is the one that can go. So you start putting on trades and then it doesn't go, it goes sideways. You say, okay, guys, that's a correction. We're going to get one more up. It started to come down. You're thinking the same thing. Then you see correction. It makes one more up. This one started to come down. You say the same thing. Turns out to be a correction. You get more up. This starts to come down. You look for sells. Turns out to be a correction. You get more up. Right? And you can continue to do that. But every time you get an opportunity for a sell, you should take it. Let it be a break-even trade, but you should take it. Because one of these eventually is going to give you that. So you will want to take every single one. That is what divergence is telling us. It's telling us that there is no momentum. Price is pushing up, but there isn't big momentum pushing this price. So you've got to look for a change of direction. And you can see from the way they're pushing it here that you're likely in some kind of a small channel. And when we see those channels, we know they will eventually break to the downside. That is what we use divergence for, to tell us when momentum is dying in the chart. And that means we start to look for a direction, either a big correction or either a change of direction of the chart. In this case, it's going to be a correction. I can tell you that right now. In this case, when we get a downside, it is going to be a bigger correction. If you go to lower time, yes, you can go to lower time frame. If you're going to go to lower time frame and look for divergence, you would look for divergence within this piece. So let's go and look for divergence within that last piece there. That is within this piece here. If you want to see divergence, you want to see divergence here to tell us when this is about to turn. See, it's the same thing. You're going to look for divergence between these impulses. And when you see divergence here, if you see that one is crossing, when you see divergence, we broke it up. Then you start to think that they could come here. And they could probably go lower into the bigger trend. Right? That is what we use divergence at. Now, let's take a pause. And the same thing here. Is that not clear to anybody? If it's not clear, give me an N. Don't be shy. I'll go through back as to why we use divergence. Great. So everybody gets it. We know now what is divergence. We know how we look for the divergence in the chart. We know what we do with the divergence, what we were expecting when we see the divergence, right? What does crossing mean in divergence? I have no idea what you mean by that, Vincent. What do you mean by crossing? Crossing what? Oh, the green to red color? It doesn't mean anything. It just means crossing the zero line. So, okay, I think I get your question. I'll answer that. I get that what you're saying. So let me come back to this piece. I'll help you here. This is how the MACD works. This is more about how MACD works. My fault. I thought everybody got that covered. So I'll explain to you how the MACD works. This is the zero line of the MACD. Right? By the way, that will be tomorrow's lesson. If we have time, we don't have time. I was going to push it in today, but we don't have time. I thought MACD divergence would be an easy thing, but it's not that easy. This is tomorrow's lesson, so I'm starting it for you. Every time you make an impulse, let's say to the upside, the MACD is going to move away from the zero line very sharp. And then the chart will start to correct. You will see the MACD come back to the zero line. It's going, as long as you're in correction, the MACD can oscillate along the zero line here. And the next impulse is going to push the MACD back. So when we're measuring divergence between the peaks of the impulses. These crossover are just where you're getting the correction. The purpose of the crossover, what you will see in the divergence when the pullback is happening is you will see a crossover. So for tomorrow's class, for those of a lot of you saw the webinar already. For those of you who didn't see it, we will tell you which piece is one piece using the MACD and how we can put all of this into one piece and how we can filter them into many pieces and how we use that to work. but that is tomorrow's class. And I think that is a problem. The next class, the next group that come will not get the recordings. I'm going to remove all the recordings before they start their classes. Because I've noticed in a number of classes, we get that problem. Some people watch all the recordings, and when they do one class, they're doing trend lines and they're asking me about patterns. They're doing fibs and they're asking me about patterns. We do MACD and they're way about where should we put the entry order in. Because they're no longer interested in this, learning this part. They already went through it and they give me the end of it already. Remember, not everybody had that opportunity. Not everybody had that opportunity to look at all the webinars, right? And even if you look at them all, you still didn't grab the concept. So I think I want you to go step by step. When you're going a little ahead of yourself, what you do is you will miss what we do with divergence. And believe me, it's not easy. Again, I'm going to stress, these things are not as easy as they look. It may look like, oh yeah, you just watch 2 impulse and you get divergence. That part is easy. The part that is not easy is what to do with the divergence. And that's what I'm trying to get you to understand. What do we do with the divergence? Most people see divergence and say, well, I'm selling right now. Somebody said they were trading divergence for a piece of time, didn't go well. It's never going to go well. Divergence never means the end of the move. Right? Divergence is not Nika's put it right, never trade divergence. It is not something to trade. So let me give you guys a number of things that we've finished this so far. And then I'll take some more questions, right? So let's go. I'm going to go through a few things. I'll stop the recording and then I'll take questions, all the questions you have. So first thing I want you to go with. We learn trends. Do not trade using the trend lines. I'll put it the way Nika's put it. Never trade using the trend lines. The trend lines are not a trading tool. It's not put there to trade. You're not going to buy off of a trend line. You're not going to sell off the top of a trend line. Don't do this and try to sell here or try to buy here. That is a huge mistake. That is not a trading strategy. Good. We have learned fibs. You can put fibs on here, right? Don't try to just buy any fibs. As a matter of fact, fibs by itself is not a trading strategy. We do have a strategy that includes the fibs, but as by itself, it's not a trading strategy. For us to buy the 618 fib, we have to have a structure that completes itself, comes to the 618, and because of risk to reward, we'll take that trade. But I'll come to that at the end. The fibs by themselves, some people say, I buy all the 618. By itself, no. You have to watch the structure, see what structure you had. Did you have a full corrective structure? Is that structure in terms of time enough? All of that. There's a number of other things you'll have to look at. And we will come to all of that later on. The time factor and all of that. Right now, we're just teaching you what the tool is, how we use it, and what it gives us, basically, right? What are the purpose of it? That's all you need to learn now. And how to use it correctly. How to use it correctly is very, very important. Let me repeat, how to use these tools correctly is super important, because as we go along, you're going to find the biggest mistakes most traders make in their trading is putting those tools incorrectly on the chart. And once you do that, you're going to have an incorrect bias. And that would lead to making wrong trades. How do I know that? I do one-on-one with traders who are not that successful. Some of them may be in the room right now. You don't have to identify yourselves. And the number one thing I see they do wrong is putting trend lines incorrectly, reading the MACD incorrectly, doing a number of things using the very basic stuff we taught them incorrectly. And as soon as I said, okay, go to the 4-hour chart and show me your trend, you immediately hear this response from them. Oh, I see where I made my mistake. Not one person. More than 90% of them give me exactly that. I said, okay, let's go to the 240 and show me the trend. They show me a perfect sell setup that they're selling. We had a flag here. I saw this. I was selling here. What went wrong there? And I was like, okay, let's go to the 240 and show me the trend. And the minute they do that, they said, okay, I can see where I'm wrong. I can see why I shouldn't be selling there. So come back to the basic stuff. Go practice it. It is not that easy. I'm telling you from my experience dealing with traders who make mistakes and get it wrong. That is their basic mistake. They take it that it's pretty easy. They think it's easy. They understand everything I show. They look at it and, hey, that's easy stuff. I've got that covered. And then they go and they start to trade. And what happens? They figure out, oh, this thing is not that easy. You know what tells them it's not easy? Their account. Their account says to them, hey, what are you doing? You're doing something wrong. Go back. And then they come and then we show them again how to do it. And then they take their time, take one chart, go through it and do it methodically, and they see success. So I want you guys to learn from their experience. The reason I'm sharing that with you is so that you can learn from their experience. Do not repeat their mistakes. Don't take it for granted that if you watch it one time and you got it, that you actually got it. Take another chart, take everything out, and see if you can repeat it on all the time frames. Go back again, take another chart, take everything out, go back and see, can I repeat all those things I learned on another chart without making mistakes? And then if you can do that over and over and over 100 times, you pretty much got it. I'm not saying if you think you got it, you didn't get it. I'm saying don't just take it for granted. Make sure you double check and triple check and go again until you think you get it. Because I can tell you from past experience, everybody who thought it was that easy regretted their mistakes. It is not. So practice, practice, practice. You can take it from Praveen and you can take it from a whole lot of the other guys. They will tell you and they're sharing their experience with you. It is not that easy as it looks. I still go in the room and some very senior traders said, darn, I'm trying to figure out what the trend is on this one. Right? That happens sometimes. We get those classes where we look at it and very senior traders are like, okay, we're trying to figure out, they'll call me and say, we're trying to figure out what the trend is here. So it is not easy. You have to just follow the rule methodically. Go to that. Let me stop the recording here so the people who will be watching wouldn't be watching too much.